Let me judge it.
Recording in progress.
Hello, everyone. Thanks for joining us. Thanks, Professor Klosinsky. Thanks, Professor Shi. It's already 10 o'clock. Let's start. Okay. Good morning, ladies and gentlemen. My name is Zhuo Xi. I'm a global strategist at the Hainan Green Finance Research Institute. This is the fourth episode of our Green Development International Seminar Series, where we will invite international experts sharing their insights related to sustainable finance. Today's seminar is called Sustainable Finance and the Cooperation Imperative. First, let me introduce our main speaker, Professor Klosinsky. Professor Klosinsky is a widely respected educator, leading author, and advisor on sustainable finance. He's a co-founder of the Sustainable Finance Institute and the co-founder of the Carbon Tracker Initiative. He has been teaching sustainable finance for more than a decade. He's been teaching at Yale University, Brown University, Columbia University, and NYU. He has published several influential books in this area. His most recent book is Modern China, Financial Cooperation for Solving Sustainability Challenges. Today, he will discuss some core ideas behind this book and his views on global sustainability in general. For example, like what are the investment opportunities and challenges, on the path to carbon neutrality, right? Then, after Professor Klosinsky's talk, we will welcome Professor Shi Yingzhe, who is the director of the research department at Hainan Green Finance Research Institute. Professor Shi is one of the leading experts in the field of sustainable finance in China, especially in the field of green bond. He is also a professor at Central University of Finance and Economics. Professor Shi Yingzhe will make comments on Professor Klosinsky's talk and share his research and insights about sustainable finance, especially from China's perspective. These two experts will have a discussion as well. Then finally, we will have a Q&A session. You can press the raise hand button in Zoom. There's a raise hand button in Zoom, or you can write in the chat box. Since most of our audience are in another broadcast platform, you can type your question in the chat box. We'll have somebody pick the questions. Then we ask the questions in the Zoom. That's how it works. Now, without further ado, let me bring you to Klosinsky. Professor Klosinsky, it's your turn.
Thank you so much. It's great to be with you. You can hear me okay?
Yep.
I'd like to share my screen, if that's okay.
Cool. You can share.
Fantastic. So, you should be able to see my screen, and great. Okay. Yeah, it's really fantastic to be with you all. We really do feel strongly that there is a cooperation imperative in front of us. The timing of our talk today with Secretary Kerry's visit to China is a coincidence, I assure you. I am just looking for... There we go. Okay. Yeah, I just wanted to start with a few personal anecdotes of where we've been going the last few years on this question of U.S.-China relations for the sake of solving sustainability challenges. In January 2019, we helped host an event at PKU's HSBC campus in Shenzhen on the future of sustainable finance in China. And we've been very dismayed at how the relationship has degraded. And, I frankly think it's largely caused by the U.S., but I think it's just very unfortunate because to solve such serious issues as climate change, we really have to do these things together. We really need to find a way to trust each other as nations, as people, and to show respect. And we're just not doing it. And I don't like any situation where we're showing up and telling others what to do as an American. So we need to find a way to collaborate and solve our challenges together. It's just we just feel very strongly about that. Actually, Secretary Kerry spoke to my Yale class in April 2019, and he was adamant that there was a way to do this and to for example, get the U.S. and China together to help the developing world accelerate their take-up of renewable energy. These challenges are serious, and the transitions will be even harder in countries like Indonesia and Malaysia. So we should be working on these things together, and we should try to get away from the negativity that all too often has come from here, frankly. It's not that long ago that we were wondering where the trade war would go and how we could build a better relationship, which was the purpose of our book, which came out just a little over a year ago. We were very honored to have a foreword from Dr. Ma Jun, the head of the chairman of the Green Finance Association, as part of the central bank. And we created this book, which was my seventh book, as part of the Sustainable Finance Institute that my co-founder and I, Wang Zhang, and 12 top students from Brown University actually put together on the subject, which was a rewarding experience, our seventh book. So we'll talk about this throughout our talk, but we really see this as just such an important thing to try to achieve together. And, it's great that Secretary Kerry was over. We need to stop being mad at each other, and especially U.S. has to stop being mad at China. We need to understand each other better to solve these sorts of challenges that we're seeing on the screen. It's not just climate change. There are systemic global challenges that remain unsolved. Often you hear about the ESG acronym, environment, social, governance. We like to extend that out to F and Q as well. F is finance. If you don't have a good business case for your solution, it won't be scalable. Or Q is quality of management, which is very important. Culture is so important in these things. And when we were in Shenzhen, the quality of air was very clear. So these are issues we all share, and we should try to solve them together. Biodiversity is a big issue, as we will hopefully see in Kunming when COP15 occurs, and so on. And we should be trying to solve these things together. We're adamant about that. So what's actually happening? We're having a situation where poor women are having to walk long distances to get drinking water in some nations. We have a challenge of a future where there'll be less land to grow food that's arable, more extreme weather, which we're experiencing all around the world. Certainly there have been floods in China, and even here, I live between New York and Boston. Just yesterday, we had record flooding. More extreme weather is expected. Biodiversity issues are expected to become significant, and we're seeing this domino effect of not getting these things right affecting other things. Many more climate refugees are expected. Deforestation is a major challenge, as we know. And the health of the oceans, whether it's plastics or just the health of the coral reefs, the quality of the water. There are many issues that we need to solve together, and this will be hard. If you look at the blue line, this is what the aggregate consensus of climate scientists tell us that we need to achieve to keep the world under 2 degrees, which even climate science is telling us 2 degrees is not enough. We need to figure out a way to do 1.5 degrees for all of our sake and bend this curve of carbon emissions. But of course, the opposite is what's happening. We have more and more people entering the middle class, and who are we in the West to tell the rest of the world what to do when our per capita carbon consumption is as high as it is here in the United States? So we need to work together. And how do we solve systemic challenges? It's really the big question. We're really big fans of systems thinking. We don't see a way of solving these challenges unless we cooperate and trust and respect each other and work on these things together. A system-wide approach that includes global investment practices taken to necessary scale, supportive global policies that can actually stick over time. Here we have the challenge of election cycles, where one government for 2 years might put a carbon price in place, and 2 years later it could be removed. We've seen this in Australia as well. But we need consistent global policy, not just global policy for its sake. And we need global corporations continuing to transform their operations and their supply chains. and adequate and necessary innovation, as well as the buy-in of the majority of the world's people for what we're trying to achieve. And that's why this recent phrase of common prosperity resonates with me. I think we need to appeal to the average person and how these things will benefit them and their families and get them to agree on the agenda that we all need to achieve together. So we really do need to tackle these issues from a systemic approach. And so let's look at what's happening today. I think this might be useful just to do a little overview of what sustainable finance is. We, in our most recent book on sustainable finance, tried to coin a phrase, the 7 tribes of sustainable investing, because sustainable finance isn't just one thing. It's actually 7 different investment strategies. And I think it's really important to understand the differences between these. So let's spend a few minutes on that. A recent report claimed that $35 trillion was investing in a sustainable manner. We think that's a little bit of an exaggeration. Most of that would be negative screening. Investors, say pension funds who choose not to invest in a particular sector, like say tobacco, that would be most of the 35 trillion. If we're being serious and analytical, maybe it's 5 trillion that's investing in a primary way in solutions of different categories. One solution category would be best in class, positive approaches to investing in, say, public companies, such as Generation Investment Management, the very successful fund manager does, and there's a great Harvard Business School case study on them. This is a rapidly growing field. We'll talk about that in a second. Impact investing has been growing. Maybe that's about $1 trillion. Temasek's investment in Leapfrog would be the largest allocation that we've seen, and we'll talk further about that as well. That's investing in solutions from a bottom-up perspective, as opposed to investing in public companies. Mostly impact investing is private investments. And separate again would be thematic investing. That's occurring across asset class. We're seeing large new funds emerge from fund managers like TPG and Brookfield, and a lot of renewable energy project finance from banks that have made $1 trillion or more commitments to sustainable finance, investments in water infrastructure, investments in renewable energy, and so on. And that's said, so these are 4 very different categories of strategy, but they all get lumped together as sustainable finance. So we think it's very important to kind of really understand the differences between these strategies, because they actually perform differently and they solve different problems. We've seen a lot of ESG integration work from the largest fund managers. Every fund manager now has to have an ESG integration strategy. That wasn't true even 2 years ago, certainly not 5 years ago here in the US. And now we're having situations where DWS last week, formerly Deutsche Bank, is under investigation from the SEC on the back of a former sustainable finance employee claiming publicly that the organization is not doing as much as it says. And the stock price went down over 10% on that news. So now sustainable finance is both strategic and material, because anything that moves the stock price 10% makes something strategic and material by definition. There's a very big area of work, mostly in the West, as involves shareholder engagement, investors choosing to build relationships typically with public companies and try to engage with them. Things like the Climate Action 100, for example, that even Chinese companies and investors are involved with. And the 7th and final tribe is minimum standards, which we think is super important. And we'll talk about that a bit more as we go forward. But in New York City, if you visit a restaurant, there's a letter on the window telling you whether if the restaurant gets an A, they passed inspection, you can trust the food. If they get a B, they had one violation that they have to clean up. And if it says grade pending, then you're concerned about trusting the restaurant. And we don't have minimum standards on investment, but increasingly we have work happening in this area, which we find exciting. So let's just take a little bit of a deeper dive on this. Many people think sustainable finance is nothing more than just tell me what you don't want to own and then let me get on with my business. Maybe that's more of a Western approach. We see divestment claims from activists on issues over time, and that can be financially challenging for pension funds, because they often see with tobacco, for example, that if they sold out of an entire sector due to peer pressure, and then they've left financial returns on the table more often than not. So this is a strategy that's kind of fading in interest from professional investors. Also, if you sell shares, if you quote unquote divest, someone else will just buy the shares instead. So increasingly people are seeing that as a form of brownwashing, as it were. You're just arguably passing a problem to someone else. Just selling shares doesn't make the problem disappear or the issue get solved. And so negative screening really was the 1.0 of what used to be called socially responsible investing, a phrase you don't hear very much anymore, which we actually tried to defeat in our first book back in 2008, Sustainable Investing, The Art of Long-Term Performance, that I did with Nick Robbins. We were really trying to draw a line in the sand and show how negative approaches could be turned into positive opportunities. And that's remained the focus of my career for the last decade plus, is how do we turn challenges into opportunities? Our second book was a series of investor case studies, trying to look at how investors were actually trying to solve these problems. Our most recent book on sustainable finance was an update to the first book and tried to kind of describe where the field was, rapidly evolving as it was at the time, and even more so the last year or so. And then we did a book on systemic solutions a few years ago, showing how corporate investment, policy, innovation strategies could run together to solve the issues of the day, which we remain convinced is the right approach. And our book last year on China, which we tried to describe the exciting rise of the Chinese nation as a leading economy, solving problems, and becoming a serious contributor to solving these things through finance. So it was a very rewarding experience to do that book. And that's a little bit of a progression as to the books we've done. And as you can see, some of our books have been translated into Chinese, most recently. The most recent book on sustainable finance from 2017. So that's been exciting. This progression from negative to positive, a great example would be generation investment management, as I mentioned, basically trying to create a way to anticipate a company that's solving a problem that will make more money as a result, using their own form of a discounted cash flow. I think it's great work. They've done very well for themselves. They've done very well for their investor clients, the LPs who've given them money. The link in there is a video that Al Gore, on the 10th anniversary of Generation, spoke to Atlantic Magazine and said that they had achieved their goal of outperforming benchmark after fees, using sustainability as a core driver. And they manage well over $20 billion, as do the other fund managers listed on the screen. They've all risen up rapidly in assets under management by taking this positive approach, the value first, keeping the financial business case in mind and looking for positive opportunities in public markets, typically. Stewart Investor is a wonderful investor, very transparent. And even Kathy Wood of ARC Innovation, who's gotten as much as $60 billion in her ETFs, talks about how she uses this lens as a core driver. So these are some of the most successful active fund managers, or in the case of Kathy Wood, an ETF manager of the day, using sustainability as a positive primary driver of their business. So this is an exciting trend that we've long been encouraging. An example would be the Brown Advisory Sustainable Growth Fund, which has gotten an enormous amount of assets in the last few years. You can see the objective of the fund. It's very clear. They're trying to invest in companies whose sustainable business strategies will lead to better earnings growth. So they have a very clear methodology for how they're trying to understand that and invest in that, and they've been outperforming and getting assets. So we'd be very excited to see this sort of strategy become common in China, because that would be a sign of the progression we need to see on climate change. And it would be great for the Chinese state of affairs, both in the business world and for the average person as well. So these are some examples that I think are worth looking at in our own work that we do in our classes. Actually, at Brown University, we partner with the University Endowment. We actually have a large asset owner society of our own on a global basis with pension funds and university endowments. the portfolios we build have consistently outperformed benchmark as well. Back in 2016, using this dual sustainability and financial lens, the stocks we chose almost doubled the S&P 500, the benchmark that we chose. This happened again recently over a 6-month period where the 6 stocks on the screen wildly outperformed the benchmark MSCI World and the S&P 500 as well. And just before the last U.S. election, we did it again, and there was dramatic outperformance again. It just keeps happening that if you are thoughtful and you apply expertise and not just look at ESG, that you can actually financially outperform using this second tribe as a strategy. The third strategy category is impact investing. Often you see this idea that somewhere between traditional investing that doesn't consider impact or ESG is on one side of the spectrum, all the way on the other side is philanthropy, where you don't expect any returns. And somewhere in the middle is this idea of sustainable investing. And the more you're kind of trying to invest in a sustainable manner, but not be philanthropy, you end up in this sort of impact category where sometimes you need blended finance support from foundations to help bring solutions to fruition around the world. Say, obviously, impact is often something that's needed in developing world countries that are doing quite poorly, and you need some bridge support as an investor to get the returns that you're seeking. And so this is an area of interesting work that continues to accelerate as well. Impact investing, we've partnered with the Global Impact Investing Network ourselves on research, again, primarily private markets, getting close to $1 trillion and invested in a whole variety of categories, everything from energy to housing to healthcare to education and so on. So it's a diverse and exciting field that's been growing pretty rapidly. As well, a good example would be the California Freshworks Fund, where you have a situation of food deserts in inner cities where poorer people live. They don't have access to healthy food. And so an investor can step in and help create ways to get healthier food to people who need it. And that improves the community. It improves the financial well-being, because if it's a successful fund, and so on. So you have these sort of double, triple bottom line attempts to solve problems that are really helping people that are most in need. Just a really great body of case studies emerging. And that's great, but how do we actually start to understand how to measure impact when we're investing in a sustainable manner? How do we actually know when our decisions are making a meaningful difference? And so let's just quickly walk through some methodologies and how that's transpiring. The field of ecological economics, the idea of putting a value on nature, whether it's soil, air, water, all living things. Natural capital involves ecosystem services. It makes human life possible. There is a question that should we put a value on nature so it becomes part of everyday decision making. There was something called the Disruptor Review out of the UK government, which basically said we're going to have to figure out a way how to do this to stop degrading nature to the degree where it starts affecting human life and outcomes for the average person. There's seminal work done by people like Robert Costanza, an article in Nature magazine, which is linked below, showing how we actually have been creating degradation costs by exceeding the planetary boundaries in certain categories on nitrogen, on biodiversity, on climate change. This is almost a generation ago now. There are different ways of taking a footprint. You can either look at one company at a time, one product at a time, which is very different. A company, you'd stop at the selling of a product to a consumer, and then it's a consumer's footprint. A product, you're looking kind of cradle to cradle throughout the life cycle of the product, including the footprint of the end of life of the product. You could look at a region, you could look at a portfolio, or you could look at a university like Yale. And these are all different perspectives. And that's important because if you're an investor, what's in scope or not in scope of your investment is really important if you're trying to invest in a low carbon manner. There's scope 1, 2, and 3. In the middle, you're seeing operational footprint. Then you have the upstream inputs, and you have the downstream impacts. There are actually 15 categories of scope 3. Often for companies, say in the consumer space, the use of sold products, say Unilever, it's about 2/3 of their footprint. And so it's really important to bring the scope 3 or supply chain impacts into the analysis to really try to be able to understand where the impacts are. And the best work that's been done on this, now 10 years old, I used to be with a company called TrueCost. We worked with PwC and a European footwear company called Puma to do a full analysis of the environmental footprint of the supply chain, all the way down to tier 4, the raw materials, the cotton, the leather, the water used to procure the cotton and leather, and then you put a price on these externalities, and you can do this analysis for thousands of suppliers and get a rough idea of where the impacts are. In this case, over 50% in the raw materials used to create the products of the business. And the 3 biggest categories: water use, greenhouse gas, and land. And so that's important, because then you can see, okay, how can I actually do something about these impacts with the limited spend any company or government agency or municipality would have to make these things better. So this is the sort of rigorous analysis on a quantitative basis that starts to get interesting, especially when we start to think about how to use this as an investor. So fast forward 3 years, KPMG then created something called True Value, and we helped them with their report, A New Vision of Value, in 2014. This now looks at not just environmental externalities, but also social externalities, the social benefit in a country like Kenya, where Safaricom is a company, and the benefit to the average African in Kenya of their mobile payment system. And so you can start to add social benefit to this sort of analysis, and you can look company by company and see how many more times above financial profit is a company creating societal benefit, in this case 10 times more, when you do the math all the way out to the economic value add. And take that one step further again, and then you have the TPG Rise Fund. They have a 6-step process. They look at themes, and that's what the best investors do in the sustainability space. They look for the themes that need to be solved. TPG then looks at social economics to calculate those social externalities, the positive benefit that investments can make, the relevance of the investment strategy, the context. And they also look at the end of life, which I really like as a private equity fund, because private equity investors typically don't own things for more than a few years. And then they make sure that the investment has a minimum multiple of societal impact beyond just financial profit. And they also can quantify how many good jobs they've created as well. So they have a really great process, and there's a great HBR piece that we normally teach from a full class on impact measurement, looking at the work of TPG and the progression of how we can actually start to understand whether our investments are having positive impact or not. As the Sustainable Finance Institute actually is working with the Global Impact Investing Network, as I mentioned, we've developed their clean energy theme, which is part of their Navigating Impact platform, which will go live in October, and that work is done now. So that's been great to see. And then if you think about impact investing and how that could be beneficial to a country like China, it becomes, I think, really super interesting. When you look at some of the realities that were faced not long ago, with 80% of underground water and 20% of farmland contaminated, and only 3% of over 60 population covered by a hospital bed, and 29% of the labor force in agriculture contributing only 9% of GDP, and 63% of rural children dropping out before junior high school. That's quite a statistic. A rural finance gap that not long ago was estimated at 3 trillion RMB, or 500 billion US dollars roughly. And the good news is that there are policies and targets, and some of these have been achieved, as we've seen with poverty alleviation achieved last year. Cities are being asked to achieve pollution standards, thresholds, and water. We've seen, obviously the Yangtze River, the fishing ban that's been put in place, and the quality of water is a focus. Treating contaminated soil and creating at least one clinic and one medical service center for every community with a population of over 30,000. So, and these things continue to accelerate, as you well know better than I. But these are also impact investment opportunities. And when you look at what can be achieved and how to measure that success, you start to get to things like, if you're going to invest in education, you can measure that in different ways. You can actually see over 2 points in time whether you've helped achieve better attendance in schools. and this is not a China-specific thing, this could be done anywhere, over 2 points in time, whether academic performance has measurably improved, whether academic completion records have increased. From an energy perspective, you can see whether the number of households have more reliable access over time in a particular region. You can see whether the clean energy mix has changed for the better, between 2 points in time, and you can see whether the earnings for households and individuals on a net basis has improved, and whether there has been a number of incremental good jobs. And if that sort of statistic was broadcast to people, they could see why this transition is so important and how actually in a net basis, it's creating a better economy for families. From a financial services perspective, you can measure whether improvement to the access to financial services is occurring, and whether there's improved financial resiliency, and whether there's an increase in firm and household income. And on food and agriculture, whether there are higher crop yields and lower crop loss, an increase in farmer margins and income stability, improved access to healthier nutrition, as we saw with that California fund, health impact metrics, whether we can see rates of care improving in different demographics, whether there's an improved health status and lower death rates, and then on technology, an increase in the digital connectivity, use of technology, and business productivity can be measured over time. The other thing that we see very strongly is that we can see whether there's better efficiency, including the idea of human capital, which is very important, measuring whether your employees are contributing positively to the organization, whether they're happy doing so and helping the company achieve its goals, whether there's revenue from sustainable products that's accelerating over time, and whether that's getting demonstrably better. If it grows at 2x, then you really have something, versus overall revenue, then you can see the momentum. Risk management, that needs to be looked at across all scopes. And so this idea of kind of growth, productivity, and risk, the idea of how any analyst would think about a company, can be considered now, whether sustainability is contributing to a company's success. Of course, we have the Sustainable Development Goals, which we believe are three different things. We actually have directly investable goals, such as we just saw, that you can actually see the impact of your dollar. You have SDGs that are not investable, like SDG 16 and 17, war and peace conditions and collaboration. And some of these are indirect, where they're systemic, and the solutions will come only with a systemic approach. So we like to think the SDGs are three categories of things, not just one. And we often do an exercise in our classes looking at that. The fourth tribe is thematic investing. We're all familiar with renewable energy and water and so on, but this really is this very exciting growth area. I actually helped start a newsletter last year called Climate Tech VC. You can just visit it at climatetechvc.org, and it's free, and there's over 15,000 subscribers. Two young women launched that who I connected, and they've kind of taken the industry by storm. And you can see the sort of progress that's been made in this field. Actually, when we hosted our event in Shenzhen, we were looking at this, and we found that, right before our event, 4 of the top 5 venture capital and private equity deals around energy smart technologies were actually coming from China. So this was already a big deal, obviously, for China. And what we're seeing now is this exciting trend of climate tech rapidly accelerating. So in the first half of this year, $16 billion was raised, more than the entirety of the past of climate tech. Over 250 venture deals, 1,000 investment firms, just an enormous amount of activity. And this is a carve out from a recent piece in the Climate Tech VC newsletter, which we actually translate and put out as the Sustainable Finance Institute in China. And then you can kind of see that screen is frozen. Where this money is actually going. You can see the number of funds, the billions of dollars that are flowing quarter by quarter, and the rapid rise of climate tech from pretty much zero 2 years ago, which is just very exciting to see so many bright young minds going after these things. And this is happening in China as well, as we well know. So it's just this race to the top that we want to see. We're tired of races to the bottom, And now it's time for a race to the top. That's why we need to work on these things together to share the innovations that we come up with. If China comes up with a great innovation, or if the U.S. does, or if Europe does, it should be a solution that we all share in and deploy and scale together. If one nation succeeds through climate technology, that's not right as far as I'm concerned. We're about 3 times at least, if not more, underinvested against the climate challenge versus what's required. There are a number of reports on this that I'd be happy to share. The Stanford's report was quite good a few years ago. As I mentioned, banks are making these $1 trillion plus commitments. Goldman's been winning a lot of deals. But we really see this $50 trillion figure as something we're going to need to really think hard about achieving. And we're going to have to get creative on that, we believe, to really get there. Because when you add up the money that's available from pension funds, that's about 50 trillion in total. So how are we going to raise another 50 trillion from just pension funds? We're going to need to be creative. The banks need to get involved. Governments will need to get involved as well. And we'll be focusing our research on that as well going forward. Right now, the value of asset classes in the world is around $500 trillion. About half is institutionally overseen or managed. About half is in the real economy. This is an analysis that we did for a chapter of a book that came out of Yale last fall, an update to our paper from the UNEP inquiry into the design of a sustainable financial system back 5 years ago, when the figure was 450 trillion. And I think that's important to put in perspective. 50 trillion sounds like a lot. It's only 10% of the value of tradable assets. So we can do this. We're just going to have to work really hard. We're going to have to work together. As I mentioned, we had Secretary Kerry in our class. That's actually a picture. The Kerry Initiative at the Jackson Institute posted that on Twitter, which was very kind of them. The Biden administration has made climate change an imperative. They've given a remit to every cabinet member. Secretary Kerry is in China as we speak, I believe, still there, or he has been for days. And there's this idea of a carbon country club, which now Nobel Prize winner Bill Nordhaus spoke about in our class in 2016. Can we have a consensus on what we need to do, work on it together? And anyone who doesn't cooperate, they get tariffs for not doing so. There's a lot of focus on net zero. And in the next few months, there'll be a lot of new announcements and initiatives. And we really need to get our act together globally. And we have to do so with trust and respect. And certainly Secretary Kerry is someone who wants to do the right thing, regardless of political posturing and that he might have to say at a certain moment. He's a very strong, excellent, and impassioned person who wants to do the right thing. The other 3 tribes, as I mentioned, ESG integration, shareholder engagement, and minimum standards. We've actually done quite a bit of work on minimum standards, not only for Yale, but also the New York State Common Retirement Fund, one of the 3 largest pension funds in the United States. They've been an advisor to them for quite some time. Their recent climate action plan in 2019 and their update from just earlier this year is extremely transparent on the progress they're trying to make on sustainable finance. So I can recommend those reports to you as leading practice from an asset owner. But there are many challenges before us, especially the inconsistency of ESG data from providers. So the largest investor in the world is the government pension fund of Japan, 1.5 trillion. They did an analysis between 2 of the major providers, FTSE, Russell, and MSCI, of Japanese companies, and there was a scatter plot of ESG ratings. So there's very low correlation of ESG evaluations more generally. MIT has created an entire unit looking at this confusion. There has been critiques from ex-employees, not just DWS, but also BlackRock, on the efficacy of the efforts of these firms. We're actually working as the Sustainable Finance Institute with CSI, the main index provider in China, to the Shanghai and Shenzhen exchange, on something that we call ESG Plus, that will actually, unlike the other providers, will not use a single global model. Will actually take into account local differences, because ESG, as we know, is very different in a country like China, where the government plays such a strong role, versus, say, in the US, where the government might try to impose things, but may not be as successful. So we really need to look not with a single global model at ESG, as the main providers tend to do. So we're excited to be helping advance the notion of what ESG looks like with Chinese characteristics. Of course, China will determine that for themselves. You don't have to listen to an old white man like me. So, but it's exciting to be part of that conversation anyway. ESG ratings. There's a great article that the Wall Street Journal published a couple of years ago looking at different companies and how inconsistent the data was. So I would recommend that to you. But the data to this day remains kind of all over the place because different providers are measuring different things, weighting ESG differently. And this helps explain why fund managers are not just pressing an ESG easy button and the best investors are typically active. Mark Mobius wrote a wonderful book called Invest for Good. It's short. I'd recommend it to you. It talks about, Mark Mobius used to be with Franklin Templeton, one of the very largest Western investors in Asia, and he talks about how to do sustainable investing well, actively, with on-the-ground due diligence and so on. An excellent book. There is some correlation between ESG and financial performance. There was a great study out of Oxford a few years ago showing how good ESG performance can result in lower cost of capital, better operational performance, and stock price performance. In Asia, the MSCI Emerging Markets ESG Fund has done better financially than the MSCI Emerging Markets Fund without ESG, but there is a question as to what they're measuring. Fidelity in Singapore found out performance for ESG last year, and as I mentioned, we're working on a better ESG framework that takes into account local differences and the importance of intangible value and the importance of support from governments and so on. So watch this space. A systems approach is required. While corporates are increasingly active on climate change, especially in the United States, that's only about a third of the issue. People are 2/3 of the footprint, people and their choices. There's some great work happening out of Netflix on net zero, Microsoft, Stripe. The technology companies in the US are focusing a lot on solutions, but we need a lot more. The systemic nature of climate change can be demonstrated by infographics such as this. Not long ago, the US energy footprint every year is measured by the Energy Information Administration, EIA, and you can see that 85% of climate change is caused by the use of fossil fuels, not the production. People get stuck on the supply of fossil fuel. Fossil fuel and carbon emissions and carbon neutrality will come from shifts in demand, shifts in how we generate electricity, shifts in how we do transportation, shifts as to industrial processes becoming more circular. 91% of transportation is coming from the use of oil in the United States. That number has stayed very consistent over time. 100 quadrillion BTUs is the total energy use, energy consumption in the United States. That's also a very consistent number of the time over time. Energy use is getting is accelerating around the world. This will only continue. It places extra pressure on this transformation imperative that we're in, which leads to the cooperation imperative to solve these problems together once again. But we've long argued that sometimes I think we have the ESG conversation exactly backwards. We need outcomes, outcomes that we can achieve. We can only achieve outcomes if we develop case studies that show results that can be scaled for solving the problems to a necessary degree. So we think the right way to measure is at a system level: annual carbon emissions, air pollution by region, good jobs, good companies to work for, whether there's good or bad governance, whether there's gender diversity. These are system level things that can be measured. And then we can work backwards and see whether the strategies we're putting in place to improve these conditions are actually delivering results. So we can measure systems and we can measure strategies, and then we're making progress. And then I mentioned strategies. There's a well-honed formula for transforming organizations. Public companies have done this the best, and private equity has taken advantage of this as well. Investors have had less success, but this is what we need to do. We need to make sure we're asking the right questions, build our capacity, make sure we have the capacity to execute, implement, measure progress, and then re-question. That's a cycle of success. To achieve important systemic goals, we need well-constructed, thoughtful investment processes, and not just corporate strategy development. So we need better strategy, better culture, using this sort of strategy planning. That is a great body of case studies of success using this sort of balanced scorecarding approach to make sure we're making progress. The maturity of markets. What is the true potential of ESG in China? I think ESG is exactly what China's already doing and will only benefit by doing more. Can Chinese innovation help the rest of Asia? How wonderful would that be? Asia's already half the world's economy by many measures, over half the world's people. So this is why the cooperation imperative is just, it's an imperative, period. In our Modern China book, we also suggested that we need a new scale for measuring success on a country level. We see markets being either mature or challenged or evolving, a sliding scale. Any country might be moving up or down that curve, and we can see where everyone is using different measures. Even stock exchanges can be measured that way. For example, the S&P 500 has been rapidly decarbonizing over time. Few talk about that. That can be a way to see whether adequate progress is being made towards mature and successful markets. Obviously, the rise of the Asian middle class is well understood. So to sort of have Western conversations only about sustainable finance, is an enormous mistake. And I'm not going to be the one to solve exactly what sustainable finance should be in China. I'm well aware of that. But if I can contribute even a little bit of knowledge from what's happening around the world, I'll feel like I've at least tried to do something helpful for China and for Asia and the world more generally. Our work has demonstrated how positive approaches have done better than negative approaches. This goes back to our first book and how we looked at the entirety of the world's sustainable funds and how the positive funds were doing better than negative funds, which at best were meeting market performance. And we believe that people and culture is super important to getting this job done. We need to have the right incentives in place, the right training and understanding of staff and credentials to back that, to help build that capacity to execute on strategy and develop those strategies with a gap analysis and other forms of understanding where we need to do better, and leadership training, which is why we launched something called the CSFA, and we are actually actively educating virtually on a global basis individuals from around the world, executives, bringing them together to do exactly what we talk about, cooperate and collaborate together on a global basis. So we're excited that that's become increasingly successful. And that's just one example of how we can actually make sure that everyone has the right training and understanding. And as I mentioned, this idea of minimum standards would be another thing to be wonderful to see around the world, in China, in Asia, everywhere. This idea of being able to trust your food, trust the products that you buy, and so on. So in conclusion, to wrap up, I think we're right on time just about. Interest in sustainable finance is at a record level. Its true size might be a question, but thoughtful ESG strategies outperform. Older strategies left a little bit of underperformance, and it left a bitter taste in some people's mouth, but the market's figuring that out. We think the maturity of economies will be tied to the sustainability transformation that we're underway with. And the transition imperative those who solve these problems will do best. And every fund manager in the West is working on this now, unlike 5 years ago. It's now a competitiveness issue, not just for fund managers, but for nations. And so it's great that Asia is getting into the game. And I think there's outsized potential for societal and financial benefit by doing so. So I hope that was interesting, and I look forward to everyone's comments and the next response as well. Thank you.
Thank you so much, Professor Klosinsky. It's an insightful talk, and what a detailed roadmap for sustainable finance. I mean, we see a lot of opportunities and the chance for cooperation. For example, as I see your notes, the low correlation between different evaluation of ESG, that alone calls for cooperation, globally. There are a lot of opportunities we can figure out, we can explore. Okay, now it's a term of Professor Shi Yingzhe from Hainan Green Finance Research Institute. Professor Shi, it's your turn.
everybody hear me?
Yes.
So thanks, Carrie, for sharing the sustainable finance with us. Actually, I read a book by Carrie. It's Sustainable Investing Revolution. I will summarize a little bit the talk by Carrie. Carrie actually introduced sustainable finance from the point of view of investment. So next, I will introduce the sustainable finance from point of view of the financial institutions, especially the practice of the financial institutions in China. Okay, because China, I think because of the investment, the world knows a lot of the development countries' practice in sustainable finance, but know little about what the Chinese market is doing. So actually, I think China sets up a very good example in this field. For example, like just imagine, in 5 years now, the Beijing air condition is as good as London. I ever had a bet with my friend in London, and now it seems is realized. Also, this achievements, most of the achievements come from the practice of the government. So because in the Chinese market, we call it top bottle practice, comparing with the US or the European market, the bottom up. So firstly, I want to say, okay, sustainable finance is actually complies with United Nations Sustainable Development Goals. There are seven goals for the sustainable development initiated by the United Nations in 2015. So if we look at the financing need, it says we need $5 to $7 trillion annually, and $4.5 trillion in developing countries. So, we will have a lot of benefits, estimated $12 trillion by 2030, with creation of 380 million new jobs. But so what's firstly, I will introduce China's achievements on sustainable development goals. So I want to say we have 4 categories to show. Firstly is the ecological conservation and the climate action. So sometimes we call it the green finance. The second one is the poverty reduction. Actually, last year, at the end of 2020, we declare we have eliminated the poverty. I mean, this poverty, we have a definition. So, next, we were doing the rural revitalization now, and now, currently, I mean, actually started from last year, we also achieved a successful epidemic control. So if we look at the map, this map shows us in this year, actually from 2050 to 2080, or 2018, 2015 to 2018, most of the China has realized a very obvious improvement in the environment. So, and last year, I think the last year, President Xi Jinping declared, we call that the carbon targets. We will reach the peak of the carbon emission before 2030 and achieve the net zero before 2060. So that is not easy. I mean, for China, because just imagine for the Western countries, they will spend at least 30 to 50 years to transit from the peak to the net zero. We will finish it in just less than 30 years. So, okay, that will be a big challenge for us, and also there is a huge funding gap for carbon neutrality. Some experts estimate we need around 3 trillion renminbi yuan annually from now on till 2060. But I think we underestimate it. Just imagine, I mean, if we want to realize the net zero for the transportation, we probably need to change all the vehicle into electrical vehicle or the cell fuel vehicle. In Chinese market, now we have 300 million vehicles. Most of them gas vehicle or diesel vehicle. So if we replace all the ones, the value will be 50 to 60 trillion renminbi yuan. So I think, I mean, wherever did some research on the funding gap, and this for example, this 2.9 trillion renminbi yuan or 3.9 trillion renminbi yuan, most of them actually will be used in the environmental protection. But if we want to achieve net zero, we will realize a revolution in almost every aspect of the society. For example, like transportation, like the energy industry, like the construction, etc. So we need a lot of money in this process. So second, the second goal, and except the green development, the second goal is the pursuit of the common prosperity. So here we show the process in the past few years. From 2015 to last year, we actually reduced 56 million poor people, and realized we call the 小康. And next step, actually we're carrying on the rural revitalization strategy. So actually, if we travel around in China, especially the countryside, we can tell in the past few years, in the past 10 years, the environment of the countryside actually changed a lot. So that shows, I mean, we have achieved, we have done a lot of job on it, and we still, we will keep doing on this field. So sustainable finance in China, So we have several concepts concepts in finance, like traditional finance, climate finance, green finance, social finance, and finally sustainable finance. And the traditional finance, we just focus on the economic profits. But now, I mean, the trend is we need to focus on not only the economic side, but also the comprehensive social side, including environment, society, and governance. So actually, Terry has introduced a lot on this field. I will skip it. And internationally, in this 30 years, a lot of international organizations set up to promote the sustainable finance. And for China, we don't have we didn't create many concepts in this field, but in the past like 10 years, we have done a lot of job. The first thing I want to introduce is our banking industry. Here, our Chinese for the Chinese banks, we did some research for Chinese banks. The sustainable finance reflects into three categories: the green credits, or green bonds, or inclusive finance, or the poverty alleviation. So, according to the data, by the end of 2020, our green credit balance of the 21 major banks in China has reached 12 trillion renminbi yuan, ranking first in the world. But I think, for example, in Europe or in the United States, there may be a lot of money on the balance sheet of green credits in the banks, but we don't know. I mean, why? Because in China, the CBRC means the banking regulator and the central banks. The central bank will ask the major banks to collect and report the credit loan to them. So, I mean, in China, in the Chinese banking system, we have the systemic regulation or system to guarantee to carry on the green loaning. And for the inclusive finance, since 2005, China has stressed the need to develop inclusive finance. If we look at the market innovation in the past 15 years, the government actually encouraged the market to do a lot of innovation. Most of the purpose of most of them actually is to do a better service to the little and we call the small and medium firms. So by the end of 2020, the 54 listed banks has put almost 8 trillion yuan into small and micro enterprises. And for the poverty alleviation, by the end of the first half of 2020, the poverty alleviation loans have reached more than 4 trillion renminbi yuan, and also benefit more than 11 million households. And that is for the banking. And for the bond market, because the green bond in the past 5 years, the Chinese green bond market set up a very good sample in the world. So I think a lot of international friends knows about the Chinese market because of the green bond. So in the China Sustainable Development bond market, we have green bond, also including the general green bond, also the carbon neutrality green bond, also blue bond. Also, we have pandemic bond. We have the rural revitalization bond. We have poverty alleviation bond, and also social bond. Okay. So the green bond, the accumulative insurance has exceeded 1.4 trillion renminbi yuan, and I think China and the U.S. are always the top two countries in the green bond market. Last year, China is number one, and also for 2016, the last years, the U.S. is the number one. So we have in the market, we have onshore and offshore green bond insurance. Also, the market is very active. If you look at the data, you'll see every year we have more than 100 green bonds insurance. Not like the other green bond market, for example, like the European or the American market. I mean, the insurance number will be insurance amount fluctuated very frequently. And this year in February, the market not only create a new product called a carbon neutrality bond. That is the first carbon neutrality labeled product, financial product. Just after a half year, the insurance size reaches 140 billion renminbi yuan, accounting almost half of the green bond market. And for the poverty alleviation bond and the rural revitalization bonds, we see in the past 5 years, there are almost 1.5 trillion renminbi yuan in this field. And last year, because of the end of the poverty alleviation, so the bond insurance is not much. And for pandemic bond, last year the insurance exceeded more 1.3 trillion yuan, and most of them comes from the pandemic treasury bond issued by the central government. And we also have some practice in the blue bond last year, 3 issuance onshore or offshore. You will see actually industrial bank is very active in this field. Also, we have the social bond. Okay, so if the audience, if you have interest to know more about the sustainable bond market, actually this year we will publish the book China Sustainable Development Bond Market Report, also the 5-year development summary of the China green bond market. Also, we have the sustainability reporting in Chinese listed banks. So I think, the Chinese market has done a lot of progress in this field, but we need to firstly we still have a lot of potential to do it. We need more institutions to participate in this field. Secondly, I think we need to enhance cooperation in this field. Just as Carrie said, we need. I mean, in the we think we need to do cooperation in the following categories. For example, like a standard, like technology and education. But standard carry just that sets the impact measurement, also how to value the natural capital. So if we need the market to accept those concepts, actually we need gradually set up the standard for the environmental and the social impact, how to measure them. Also for the technology and introduce the carbon footprint. And also, I mean, the market, we need the technology to track or to measure the carbon footprint. Also for the education, I mean, this sustainable development is not just for the financial institutions. Actually, it's for everyone. So we need to promote education. I mean, for the whole society. And in this field, I think the U.S. and the United States and the Europe actually, I mean, they have a very mature educational system in this field. So we can do cooperation, I mean, in standard technology and education. Okay. That's what I want to introduce briefly.
Okay, thanks so much, Professor Shi. Professor Shi described the sustainable finance from China's perspective. It's more about top-down kind of structure compared to Professor Klosinsky's investment perspective from more like bottom-up. But Professor Klosinsky also called for the government cooperation. So I do see there are a lot of opportunities between, U.S. and China in terms of cooperation, in terms of research, even for instance the measurement and the standard, the minimum standard, or this kind of study. I do see the huge opportunities for different institute from for instance Sustainable Finance Institute from the United States or us, Hainan Green Finance Research Institute. The space for cooperation, for research, there do exist, because for China, we as Hainan Green Finance Research Institute, we can see the problem from China's perspective, more from government, from cooperation in China. So that's pretty much the discussion part. Professor Klosinsky, do you have any response to Professor Shi's talk? Please.
No, it's fantastic to share the platform together, and it's exactly for me this last hour and 15 minutes. All three of us, perfect example of how the cooperation imperative could actually work. We all share ideas, perspectives from different regions, and try to build progress together across what companies, what investors, and what governments need to do together. And the more trust and respect that we have in each other, that we've been able to develop. I just love to see more in the United States trying as well, and we'll continue to go at it. So count me in on the cooperation imperative. Okay,
thanks. Now we're getting to the last session. So it's Q&A session. For the people in the Zoom, if you have any questions, you can directly ask, or you can type into the chat box. I will ask the questions for you. And also for the most of the people actually are in another broadcast platform. If you have any questions, you can also put it in the chat box. We'll check another platform we'll pick some questions for the two experts. Okay, it's your turn. Let me see. Is for Professor Klosinsky. What do you think is the main barrier for emerging markets like China to leverage sustainable funding? What can the financial institutions to do to balance the response, investment, and economic benefits?
Yeah, thank you very much for that question. What's really been interesting with all of the trade war and the friction that sometimes we see between the U.S. and China, actually, we're not aware of a single financial institution slowing down in trying to do business in China, whether it's BlackRock, Blackstone, Goldman Sachs, JP Morgan. All of these firms are full speed ahead trying to do business in China. They can see the opportunity, they can see the importance of the work, and they do their work well. And so there's an opportunity for China to learn from these firms. But also, the same way that the sustainability challenges are global and systemic, so is the opportunity. So, we should be cooperating as financial institutions and operating globally. Chinese institutions should be operating around the world, and Western institutions should be operating in emerging markets as well. So I think that's the main goal that I'd like to see happen, is to share learning between financial institutions, both in China and outside of China, and share the opportunity. China has the second largest pool of wealth capital in the world. And so this is something that Chinese institutions should benefit from, and so should Western, and they should work on this together. I think that would take us down the path that we need to go on. Thank you.
Okay, thank you. The next question is for Professor Shilingzhe. What do you think China's sustainable bond market in the next 5 years? For now, what can be done by government and financial institutions to improve the market?
That is a good question. Actually, last year I had a concern about the green bond market because last year the issuance of the green bond is actually the growth of the market was season. But at the end of last year, President Xi Jinping, proposed the 2 carbon targets. I think that is a turning point, not only for the financial market, but also for the whole society. So I think the market for next 5 years, no doubtly, will keep growing based on the following 2 reasons. The first one is, I think, the policy side. To realize the 2 carbon targets, the governments now, I think, as I hear, is doing research to carry out some policies to support. Give the real support on the green financial products. So if it comes true, it will be very. You will get a real return if you hold the green financial products. That is the first point I want to emphasize. The second one is, if you look at our research in the China green bond market, we have labeled green bond in China. We also have the unlabeled green bond. The unlabeled green bond, we start to collect the unlabeled green bond data 5 years ago. So the reason is that shows the potential of the green bond market. So the data shows, for example, the data shows the unlabeled green bond, the amount can be 3 to 10 times of the labeled green bond amount. That means for the whole market, we have a very big potential to issue green bond. Based on these 2 points, I'm very optimistic.
All right, thank you so much. Yeah, this seems to be a great potential for the sustainable finance market in China. And the next question is from another platform. It's for both experts, Professor Klosinsky and Professor Xinzhe. What about the central bank's stance on sustainable finance in U.S. and in China? Professor Klosinsky, can you answer it first? Thank you.
Sure. Thank you. Thank you for the question. It's very exciting to see central bankers working together on these challenges. That's probably, in many ways, I believe Dr. Machin has led this effort, the NGFS, which is very exciting. Even under the previous administration in the U.S., I think there was some thought of there being participation from the U.S. And now the U.S. is fully in. So it'll be very interesting to see how this plays out over the next few months, leading up to COP26. That we expect there to be a lot of work happening and tipping the balance for this notion of net zero carbon neutrality, which is just so important. It's important for everyone. And so what we need is that consensus, right? So now we're getting closer to having these central bankers together and being able to act in unison. That has a lot of potential, such as the likes of Nobel Prize winner Nordhaus has long talked about. So we're excited to see what the next few months have in store for us in this regard. So I don't want to anticipate what the central bankers will do, but I look forward to my colleagues' answer as well. Thank you.
Thank you. Professor Xinzhe, do you have any stance on Chinese central bank stance on?
Actually, I think we need a global cooperation in this field. For example, like for the Basel Protocol. So we value the risk. We always value the market risk in the Basel contract or Basel Protocol. But is that possible? For under the cooperation of the international central banks to change the rule. If we can change, the rule and combine the green and the E and S, the environmental and the social factors into the new Basel, I think that will have a very big influence on the financial institutions, especially banks. So I think that is one point, the first point. Second point, I think that is the standard. Now we're carrying on the standard unification, between China and the European Union. And how about United States? If we can set up, the common standard for the greenness, so that will benefit the market, greatly. So that is what we can do for the following step, but I don't know when. All right, that's it. Thank you.
Thank you, Professor. Okay, there's one last question for Professor Karen Klosinsky. That's basically, it's a question about for for students in China, how can we get that at the last page of your slides, there's a charter, right? It's sort of like sustainable financial analysis or something like that. How can we get this kind of education? That's a question.
Yeah, absolutely. So we believe that this is not just a China opportunity, that every country, the United States, doesn't have enough education on sustainability. So the opportunity is in China as well to have fundamental on education on climate change, environmental issues, and the idea of common prosperity. I think that's an exciting concept. So, and education that shows people how they can contribute. That's what we try to bring with our teaching at Yale, at Brown, at NYU, in the CSFA program we've launched as the Sustainable Finance Institute. We're scheduled to do education in Guangdong province. So we're very excited actually about helping, but there's so much that's needed. There's so many primary, secondary, university schools, in academic institutions in China. It's just fantastic to be on a panel with fellow educators. We're just hoping to share a little bit of our technique, which I think you've heard from my talk, and inspire young people to take on this opportunity, help them get jobs in the field, help them create better strategies inside of institutions, not only in China, but around the world. So we're always thrilled to work with young students, young people, and help them envision the positive opportunities and not be negative about the challenges we face, to see them as career choices and to try to inspire them. So we're hoping to have more educators do this work that I think the three of us do. We just love to see, much more is needed, and and I think we'll get there. I think China's excited about this opportunity, and will look to leverage the work of us all and try to bring these opportunities to students increasingly. Academic institutions globally change slowly. That happens a lot here as well. So we have to be patient, but also sharing our knowledge and being positive about it, and help the students find their way, and help them contribute to the changes we all see. Thank you.
Yes, thanks so much, Carrie. The thing is, so right now, are you guys work with any academic institutions in China, like provide this kind of sustainable finance education?
At this point, we do not, but not at the university level. But we are hoping to do that, and we're obviously be excited to have further conversations on that.
Yeah, I mean, that's also one opportunities I see the space for cooperation, because that's also what our institution try to incorporate with, try to work with academic institutions, even for the adult education, for the professional education, try to bring sustainable finance, the culture, the knowledge into the system. I see there are a lot of opportunities for us institutions to incorporate. Yeah,
absolutely. I share your enthusiasm. Thank you.
Thank you so much. Oh, all right. I think time is up. Thanks so much, Professor Carrie Klosinsky, Professor Shi Yingzhe. It's a great time. Thanks so much for joining us. It's a great time to have you two, the experts, share with us your insights about sustainable finance, either in China or from a Western investment point of view. Thanks so much. Bye-bye.
Thank you so much.
Thanks so much. Bye.
Bye now.
Thank you so much.